In this webinar, we cover limited liability companies, which are LLCs, and qualified joint ventures.
LLCs. Now, finally, we're going to talk about LLCs. An LLC is a limited liability company. It's another type of business entity that can be formed under state law. Depending on whether it has a single owner or multiple owners, an LLC will be treated for federal tax purposes either as a disregarded entity. That's if it has one owner, and that owner forms the LLC and does nothing after that. It's a disregarded entity if it's a single owner, and then it's formed and the owner makes no other elections after that. That's a disregarded entity. It can also be treated as a corporation. An LLC can be treated as a C corporation or as an S corporation if the owners decide to make that election. They can make an election to be treated as a C corporation or as an S corporation, or as a partnership if the LLC has more than one owner. Most LLCs in the United States are taxed as partnerships. If a multi-member limited liability company, an MMLLC, is treated as a partnership for tax purposes, it must file a Form 1065 annually, and one of its owners or members must sign the return. A professional service limited liability company, or PLLC, is a type of limited liability company that is owned and operated by licensed professionals such as doctors, lawyers, engineers, and CPAs. PLLCs are not available in every state and have ownership restrictions and can generally only offer services related to its profession. Only about half of the U.S. states offer the option of a professional limited liability company. This would be for a professional services firm. So if you have a professional services firm, like it's a doctor, a veterinarian, a lawyer, an engineer, a CPA, most of the time they don't have the option to form an LLC in their state unless the state offers a professional service limited liability company option. And these are not available in every state. Only about half of the U.S. states will allow a professional services firm to form a PLLC. Let's talk about qualified joint ventures. Often, a small business is operated by spouses without incorporating or creating a formal partnership agreement. We're just talking about spousal-owned businesses here. The qualified joint venture is a business that's owned and operated by two spouses, a married couple. The business is usually considered a partnership whether or not there is a formal partnership agreement. So a partnership is the default. A qualified joint venture is an election, always, because both spouses have to agree and they also have to file jointly in order to make this election. If they don't agree and they don't file jointly, then it's not a qualified joint venture. It's always an election. The default is a partnership. If both spouses materially participate as the only members of a jointly owned and operated business, the business can be treated as a qualified joint venture or QJV. The spouses then must file separate Schedule Cs and separate Schedule SEs. You have to file two. And the reason why you have to file two is because if you only file one Schedule C, then only one Schedule SE is going to be generated by your software. And both spouses have to have a Schedule SE because both of them have self-employment tax that's going to be allocated to their Social Security and Medicare accounts. You don't want to have a situation where you have a business that's operated by two spouses where you're only allocating all of the Social Security and Medicare tax to one of them if they're both running the business together. You want to make sure that both of them get Social Security and Medicare tax allocated to them. What happens if you don't do that is one of those spouses is going to go down to the Social Security office and they're going to look at their Social Security statement and realize that they're not getting allocated Social Security and Medicare. And sometimes it'll make it so that they can't claim Social Security and Medicare for themselves when they turn 65. So you never want to do this. You always want to make sure that if it is a qualified joint venture and both of the spouses are actually running the business, that you file separate Schedule Cs and separate Schedule SEs, where the self-employment tax gets calculated for both of the spouses. Now, this option is only available to married couples who file a joint tax return. They have to file jointly in order to make this election. A partnership would be required to file a partnership tax return if the entity is a state-level entity, such as an MMLLC. This is a multi-member LLC. In general, if the spouses form an LLC and both of them are owners, they cannot file as a qualified joint venture once they form a state-level entity. There is a narrow exception in the law for married couples who live in a community property state. Married couples who co-own and operate an MMLLC, that stands for multi-member LLC, once again, in a community property state may still file as a qualified joint venture. Community property states are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. If they are domiciled in one of those states and their LLC is organized and formed in one of those states, then they can file as a qualified joint venture if it's a married couple and they have an LLC. But if they have an LLC and it's a married couple and they are not in one of these states, then the qualified joint venture is no longer available to them. And I'm going to show you where it says this on the IRS website, so you believe me, because people argue with me about this all the time. So I'm going to show you where this is on the IRS website. Here I am on the IRS website, and at the top of the page, it says Election for Married Couple Unincorporated Businesses. An unincorporated business jointly owned by a married couple is generally classified as a partnership for federal tax purposes. So the qualified joint venture is always an election. The default is a partnership, even if it's a business that's jointly owned and run by a married couple. Because a business jointly owned and operated by a married couple is generally treated as a partnership for federal tax purposes, the spouses must comply with filing and record-keeping requirements imposed on partnerships and their partners. Married co-owners failing to file properly as a partnership may have been reporting on a Schedule C in the name of one spouse, so that only one spouse received credit for Social Security and Medicare coverage purposes. You might not think this is a big deal, but when taxpayers reach, 62, 63, 65, and they're getting close to being able to claim Social Security, if you've been doing this and you've just been filing on one Schedule C for them, and the other spouse wants to go claim Social Security for themselves, they're going to get very upset if this wasn't done properly. You want to make sure that if it's a married couple business and both of them are working in the business, that both of them are getting credit for Social Security and Medicare. The only way to do that is to either file a partnership tax return, and then half of the Social Security and Medicare tax is going to get automatically allocated to either one, or if you're filing as a qualified joint venture, you need to file 2 Schedule Cs and 2 Schedule SEs. The Schedule SE is where the Social Security and Medicare tax gets allocated to both spouses or either spouse. That's where the allocation happens, is there on the Schedule SE. The definition of a qualified joint venture is a joint venture that conducts a trade or business where the only members of the joint venture are a married couple who file a joint return. Once again, they have to file jointly. If they file MFS, they can't make the qualified joint venture election. Both spouses materially participate in the trade or business, and both spouses elect not to be treated as a partnership. If you go down a little bit, it says a business owned and operated by the spouses through a limited liability company does not qualify for the election. Only businesses that are owned and operated by spouses as co-owners and not in the name of a state law entity. This would include limited liability companies. This would include LPs, LLPs, any kind of a state law entity. Once you form a state law entity, you cannot qualify for the qualified joint venture election except to married couple businesses in community property states. And there's the Rev Proc right there if you want to read it. It's Revenue Procedure 2002-69 and Revenue Procedure 2002-2, which means that the IRS has actually issued this guidance since 2002. So it's been 20 years that married couple businesses were allowed to make a qualified joint venture election in community property states. And I'm going to show you the Rev Proc so you can see it. As you can see here, I'm on Revenue Procedure 2002-69. This is official IRS guidance. And this is the section right here, the section 3, that talks about the exception for community property states. So it says here, this revenue procedure provides guidance on the classification for federal tax purposes of a qualified entity. They're talking about qualified joint ventures. A business entity is a qualified entity if the business entity is wholly owned by a husband and wife or two spouses in the case of a same-sex couple, as community property under the laws of a state, a foreign country, or a possession of the United States. No person other than one or both spouses would be considered an owner for federal tax purposes. What this means is that once you add another person into the mix of ownership, then it can't be treated as a qualified joint venture anymore. So for example, if you have a married couple and they are the owners of the business, and then you add a third person, like let's say you add an adult child as an owner or a sibling of one of the owners or whatever, it doesn't matter. Once you add a third person to the ownership of the business, at that point, the qualified joint venture election is not available anymore, regardless of what state you live in or whether it's a community property state or not. Once you have a third person that's not the spouse, then it's not a qualified joint venture anymore, and you have to file a partnership tax return, period. Okay? This is only available to married couples where the only owners in the business are the spouses themselves. And then lastly, the business entity is not treated as a corporation. So it's an unincorporated business owned and operated by a married couple. If they're in a community property state, then they can still file as a qualified joint venture on 2 Schedule Cs and 2 Schedule SEs, even if they form a state law entity. But once they form a state law entity, if it's not a community property state, then they have to file a partnership tax return. And I wanted to show you on the Schedule E, you can make a qualified joint venture election on the Schedule E as well as the Schedule C. If you look right here in the middle of the page, it says check the qualified joint venture box, only if you meet the requirements to file as a qualified joint venture. So you can actually make a qualified joint venture election on the Schedule C as well as the Schedule E. There's a box for you to do it here as well. And let me give you 2 examples. Roger and Joanna live in Hawaii, where they operate a small business together as husband and wife. They qualify for and treat their business as a qualified joint venture and file on 2 Schedule Cs. Later in the year, they decide to form an LLC. They must file a partnership tax return, which is the Form 1065 for their business, starting with the date of the formation of the LLC. So as soon as they form that LLC, that's when the filing requirement for a partnership begins. They can no longer treat their business activity as a qualified joint venture because Hawaii is not a community property state. Example number 2. Grant and Natalie are married and file jointly. They live in Texas and run a small grocery store together as a qualified joint venture. During the year, they form an LLC for liability protection. Since Texas is a community property state, they are allowed to continue treating their business as a qualified joint venture and report their income and loss on 2 Schedule Cs.
The next video covers farmers and exempt organizations.